The Chinese economy and stock market is falling. This week, the Chinese stock market also entered bear market territory, which means that their stock market is now 20% at least off of their highs, and it's now starting to impact the United States. I'll show you. So earlier this week, the Chinese central bank issued a surprise rate cut. Remember, central banks have the ability to control things like interest rates to influence the economy. When you cut interest rates, it stimulates spending to boost the economy. But the interesting thing isn't that they just cut interest rates. The interesting thing is when they decided to cut interest rates, because the Chinese central bank cut interest rates 1 hour before the Chinese government was scheduled to release the latest economic data. Now, why would they do that? Well, cutting interest rates helps to stimulate the economy, and the Chinese economic report that was released essentially said that the Chinese government is slowing, or the Chinese economy is slowing slower than what was expected. And the Chinese government also omitted some key pieces of economic data from the report. Now, why would they do that? Well, one of the pieces of data that they omitted was youth unemployment. Now, what is youth unemployment? This is the unemployment rate for young people, people who just graduated college, maybe people who are in college. And the reason why they might have done that, because obviously we don't know, could be because in their previous economic report, youth unemployment broke a brand new record high in China. In the previous economic report, youth unemployment was higher than 21%, which means that over 1 out of 5 young people can't find a job. So maybe that has something to do with it. But before we go into why it's even getting worse after this, let me read you what the Chinese government said regarding this economic report. They said that we should be aware that the international political and economic situation in China is intricate and complicated. While the domestic demand remains insufficient and the foundation for economic recovery needs to be further consolidated. So yeah, we got some issues going on politically and economically, but it's complicated and we're working to get things sorted out. That's what the government had to say. But then things got even worse this week because Evergrande, who was China's second largest property developer and one of the largest debt holders in the world, declared bankruptcy in the United States. Now, the reason why this is so significant in China is because real estate has a very integral part of their economy, even more so than the United States. I'll explain why. And the second reason why this is so significant for the United States is because, like I said just a second ago, Evergrande was one of the largest debt holder corporations in the world. And a big chunk of their debt was held by people, institutions in the United States. Here's what Barron's had to say. Barron's said that Evergrande filed bankruptcy in Manhattan, and Evergrande's corporate debt was widely held amongst Western institutional investors. So Evergrande had about $31.7 billion worth of debt that they were working to restructure. Now they declared bankruptcy, and it looks like most of the corporate debt wasn't held in China, but it was held by banks and institutions outside of China in the West, and part of that might be, or seems to be, in the United States. Now, going back now to why this matters in China, the reason why is because property or real estate is looked at very differently in China than it is in the United States. Real estate is a big deal in the United States. People hold their wealth in the United States in real estate, but in China, take it to the next level. People use their homes as savings accounts, as a way to build and grow their wealth. They do that here in the United States, but even more in China. And then the way that Chinese real estate development is done is through this system where you essentially buy a home that's not built, you pay the money, but the developers use the money to go out and build a different development. So then the next development money is going to be used to pay for your building. So this is called their pre-sales process, where they pre-sell you a home, they get the money, and then they start the next development, and then the next development money that they raise is used to build your home. Some people like to call it a pyramid scheme, because if you start to look at how all these pre-sales work, is you go out and sell these things to build these homes, and then use this money to pay these people, then you go out and build these homes to pay these people. It starts to look like a pyramid scheme. But this has been going on for a while, and a lot of people save a lot of their wealth in real estate, and they're buying these homes to pass on their wealth, and it's a big deal. And now, because we're seeing these property developers go under, some people are not getting their homes that they're paid for. So you can start to see why that's such a big deal. And when Evergrande started to default, because they actually defaulted back in 2021, it triggered a whole wave of property developer defaults in China. So they were not the only developer that defaulted, which is why it's such a big deal, because it's impacting the Chinese economy in so many different ways, because now banks are struggling, the developers are struggling, and consumers are losing the money that they invested. Because now you go to buy a home, right? You go and buy this pre-sale home, you give them your money, the developers take the money and they just want to start to build another property. They borrow money from a bank, but now if the developer goes bankrupt, they've already lost your money as the homeowner and they've lost the bank's money. And that's where it's starting to cause a lot more issues in China. And that's just one of the reasons why now the Chinese economy is really starting to hurt. What they said about the Chinese real estate market, as most new homes in China are sold before they are built, this is the pre-sale process, one distortion comes from a regulatory ceiling on those projects through a quote pre-sales permit, like what I was talking about, where local authorities have set home prices the developers intend to sell their properties for. Essentially, like I was just saying, you have this system in China where people buy homes before they're built, they pay the money up front, developers take the money, start working on another project, and then you hope that they're gonna come back and start building your home. That way you actually have something that you paid for. And so now it's the banks that are getting screwed, the homeowners that are getting screwed, and the developers that are going bankrupt. Now the question is, once you understand what's going on in China, which is obviously concerning, how does it affect the United States, besides the fact that Evergrande has a lot of debt, over $31 billion worth of debt, some of it which is held by United States institutions. Well, this is what Barclays said in a report that they put out yesterday. They said, quote, markets are being hit by the perfect storm. Markets meaning our stock market here in the United States, because of rising interest rates here in the United States, grim economic data in China, and other factors such as the higher treasury yields. So what we're seeing right now is obviously investors are concerned about what's going on in China. They're concerned about how that's going to impact other parts of the economy. They're concerned about how lenders in China or in companies in China are defaulting, which could impact lenders here. And then they're looking at issues in the United States, such as the high inflation, because the Federal Reserve Bank, remember, this week came out and said that bringing inflation down is still an uphill battle. There could be more work to do ahead. And then on top of that, we have seen our treasury yields, particularly the 10-year treasury yield here in the United States, really rise. Now, why does that matter? If you've been following my previous videos or you've been following Market Briefs, my free financial newsletter, which is why if you haven't joined Market Briefs yet, I highly recommend you do so. It's an easy and free way for you to stay up to date on what's going on in the markets. If you haven't joined Market Briefs yet, you can read it for free, and I got the link for you down in the description below. But the reason why these treasury yields matter is because when you lend money to the government, this is what treasuries are. You lend money to the government. It's a place where investors can park their money and earn some interest. The government pays you back plus interest. Now, any financial or economic book will tell you that the least risky place to invest your money is in the government, by giving the government money. That's why giving money to the government, this treasury yield, bond or note, is called a risk-free return, because the government always pays back their debts. Well, there's a problem when interest rates start to rise, because now when the treasury yield rises, that means the risk-free rate rises. Now, the reason why that's so significant is because that means now if you wanted to go and get a mortgage, that means the bank is making an investment. The bank is going to lend you money. And so if the bank is going to lend you money, you are a more risky investment than the government is. So if the government is paying out a higher risk-free rate, that means the bank is going to have to charge a higher rate to you, because why would I want to charge you just 6.5% on a mortgage if I could get a close to rate like that from the government? I need a better return if I'm going to make a more risky investment. So as the risk-free rate rises, the rate you pay as a person, whether it's for a car or a home or credit card, you got to pay more money because you're more risky than the government. Which means as treasury yields rise, interest rates for everything, corporate debt, national debt, credit card debt, mortgage debt, also starts to rise. And that impacts people's ability to spend here in the United States. As people's ability to spend gets hurt here in the United States, that hurts businesses here in the United States. Which is why, well, there's a lot of potential concerns in the United States about the health of our economy. How shielded are we from other issues like China? And this is why I keep saying, listen to me carefully. 2023 is not the year for you to go out and finance a new truck. 2023 is the year for you to get financially smart. There are a lot of red flags out there. Get prepared for whatever it might be. Maybe it's nothing, okay? Maybe nothing bad happens. That's fine. But at least you're prepared. It doesn't hurt to do anything to be prepared, and it doesn't hurt to be prepared. But if you are prepared, and let's just say now, student loans restart, people start to struggle more. Then 2024 comes, interest rates stay high, and then we start to see more slowdowns in the economy. And then you start to see profits start to go down. Well, now, if that happens, that could cause potential sell-offs. Maybe it happens in 2025, but you have to be prepared, because if that were to happen, you want to be the one that can capitalize on investment opportunities, but you can only do so if, number one, you're financially educated, number two, if you're prepared to actually capitalize on opportunities, meaning you have money. Because you can see the best investment opportunity in the world, but if you don't have the money to capitalize on it, it doesn't do you any good. So understand, yeah, there's a lot of issues going on in China. There's a lot of issues going on in Russia. There's a lot of issues in different parts of the world. That could impact the United States, and it can also kind of foreshadow things that could happen here too, which is why it's important to pay attention to what's happening. We're keeping you posted on market briefs, but also why it's so important for you to be preparing yourself financially. That way you're educated on what's going on.